And in order to utilize this tool right, there's this concept of market memory or look back that I need to share with you. Now, in all my experience as being a trainer or a teacher to literally hundreds, if not thousands of traders, either in person or online, through magazine articles, at expos, whatever it may be, it's been my experience that most traders don't look at a particular set of data, of price data, in a consistent way. In other words, they just pretty much look at, one, what's comfortable to look at, or two, however the chart opens, depending upon the size of the chart, depending upon the size of their monitors. Those are all very random reasons. And it became my observation over, it didn't take too long, that typically new traders look at very little data, and experienced traders tend to go to the other side of the pendulum, which is they kind of overdo it. Okay? They look at too much data. So when you take a look at how much data you're looking at, I realize to a certain degree some of it might even have to do with if you're nearsighted or not. I'm terribly nearsighted. Sometimes there is a comfort level to what we actually look at in terms of our charts data. Again, what I call market memory or look back. So I'm going to give you the settings that I feel are most appropriate for the time frames that I most commonly trade. And we'll go ahead and start with the 5-minute chart. So with the 5-minute chart, I have a intraday swing trading strategy that I utilize, which we won't be talking about today, but we will definitely be talking about as we approach our Super Saturday, and probably I'll go over it in detail during our Super Saturday talk. So what we want to do is, on the market memory of a 5-minute, you need about 2 days. Now remember, what we're trying to do with this market memory is have a sufficient amount of data to recognize a couple key things, key highs, key lows, be able to recognize significant rallies or sell-offs that have happened recently that could be affecting the market psychology. We want to take a look at, in the case of a 5-minute chart, the previous session's high-low close. Okay, any significant highs or lows that have occurred. So 2 days is about what you need for the 5-minute chart. For the 15-minute chart, my look back is 3 to 5 days. Now when I say look back, I don't mean you have to be in this view the entire time. It's during the setup process that I think you should go into this view, and then at that point determine, again, the last major move, some of the key highs and lows, what the overall sentiment has been on this time frame throughout the market memory. If you like Fibonacci, this is where you'll look for the highs and lows for most recent Fibonacci's. If you like to draw your own trend lines, this is where you'll look and identify touch points that'll leave you, in my opinion, the most relevant trend lines. Okay? The market memory reflects the fact that on a 5-minute chart, a short-term intraday chart, knowing what happened last week really doesn't apply to this psychology, to this slice of psychology, to this slice of time. Okay? One of the most common questions I get is, how often do I hold a trade? And I always answer it the same way. Depends upon what time frame I'm looking at. Because there is no way that I'm going to be holding a 5-minute chart for days and days and days. The psychology is not designed to reflect that type of length, that type of, no market moves straight up or straight down for 3 days. None. Okay? Not when you break it down into a 5-minute chart, because we'll see the nuances, the shifts in opinions that occur basically 12 times per hour, right? In a 5-minute chart, we get 12 new candles per hour. If I wanted to see that straight up, straight down psychology over the course of weeks or months, I need to utilize a daily chart. Okay, if I want to take a look at the psychology over the course of the day, I'll probably look at a 15, 30, or 60. But again, you're looking at a particular slice of psychology as represented by the time frame. Your time frame will dictate how long you hold the trade. I'm not going to enter a 4-hour chart and hold it for 30 minutes, because the 4-hour chart, the making of the pattern, the making of that setup, likely took days, right? I mean, we only get 6 new 4-hour candles a day, right? So unless it's a correction I was waiting on, even that might take a handful of candles. This thing could take half a day to a full day to even form and trigger. If it's a chart pattern, it could be weeks. All right? So if I've got a pattern that took weeks to develop, am I going to only likely hold that for 30 minutes? Based upon the price movement of a 4-hour chart and the support and resistance it creates, chances are I'm going to be holding it for half a day, or a few days. So the time you hold a position, the time that you are exposed to the risk of being in the market is very much dictated by your time frames. Therefore, longer term time frames, as dictated by the range you will see every single day, on, for example, a daily chart, okay, are inherently going to have more risk and potentially more reward. Okay, so let's go back to this idea of this look back, the market cycles, and go through the remainder of these time frames. So the 30-minute chart is a minimum of 1 week and a maximum of 2. So no more than 2 weeks, no less than 1. So you're basically looking at 5 to 10 trading days. On a 60-minute chart, you are looking at 2 weeks, okay, approximately 10 trading days. Now, I'll say approximately, I'll give you these guidelines because you and I both know that when you are scaling this horizontal axis, the time axis on your chart, that prices don't necessarily allow you to be very specific. You might have, for a 2-week look back, you might be closer to 3 weeks. That's fine. If that's where the scale is bringing you, that's fine. I would rather you err on the side of a little more data than less. So if you have to jump between, say, 9 days and 17 days for a 2-week look back, go with the 17. Okay? I realize that not all these axis slides are going to give you exactly the look back that I'm talking about here today. Okay? So always err on the side of a little bit more data. But don't make the mistake of thinking that more data is better. Okay? That's not the case either. Get as close as you can, and I'd rather you be a little bit over than a little bit under. Yes? Okay, so again, 2 weeks or about 10 trading days on the 60-minute chart. On the 4-hour chart, I think you need a minimum of 1 month. You might find yourself closer to 6 weeks, and that's absolutely fine. Sometimes with the way my calendar access slide works, I get closer to 2 months. But again, I'd rather be a little bit over than under. 4 to 6 weeks is absolutely fine. That's a good look back for the 4-hour chart. Finally, the daily chart. You know, 52-week highs and lows matter. And that tells me, just like 1 month highs and lows matter to a 4-hour chart. So that's why for a daily chart, you're going to utilize 1 year. Now again, you don't have to be in this look back the entire time. Now notice here I have October of 2008. That's way more than I need, right? Let's see. This is June of 2009. See, do you see the way it's jumping? This is, see, it's jumping. So I've either got June of 2009, I've got October of 2008. I've got to go with October. Do you see what I mean? So sometimes you can't get exact. I'd rather you be a little over than under. I'd rather you have October of 08 than June of 09. I want you to have that 1 year. Now, for those of you that are wondering, this is the same moving average we've had on these charts since we put them on together a session or so ago. And it's the 200 period simple. Okay, it's a 200 period simple. Two very common moving averages in any market are the 200 period simple. That's the most psychologically relevant time frame as applied to a daily chart. Another very popular one is the 50. In fact, when you see the 50 and 200 cross, sometimes people will call that a golden cross. And all that should mean to you, not that it's the best tool in the world, what that should mean to you is psychologically people are watching it, and what kind of reaction will accompany that psychological reaction to this idea of this golden cross, the 50 crossing through the 200. In fact, that's happening right now in the dollar index, but I digress. So we've got the look backs here. And again, what you need to do in this look back is identify the trend, identify near-term highs and lows, the highs and lows that occur within this look back. You want to get an idea of what price action has been doing within this time. Okay, this is where you draw your trend lines. All right, this is where you would, if you're looking for chart patterns, this is the look back from which you'll look for chart patterns. Okay, so this is where you do the bulk of your charting analysis, your price study. And then once you've done all that, by the way, feel free to exit this view. You don't have to stay stuck in it. It's just when you're doing your analysis, I want you to do it within that market memory. Now, the main reason for my coming up with this market memory concept was the tool that I use in order to recognize